Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the massive AI infrastructure arms race.
Yeah, massive is definitely the word. It's not just a race. It feels more like a profound tectonic shift in how global capital is being allocated. We are seeing financial commitments, the likes of which we haven't seen in decades, really.
Yeah.
And it's all happening at, well, warp speed.
That's exactly the core of our deep dive today. Our mission, for you listening, is to really dissect these monumental financial commitments that are driving all this competition. And we want to analyze the different strategies of the big hyperscalers. We're talking Amazon, Alphabet, Microsoft, Meta.
Right.
Assess the potential for, the dreaded AI bubble talk.
It's out there.
And ultimately figure out the real risks and rewards for you, whether you're an investor or just trying to learn and navigate this whole new landscape.
And look, if you need just one number, an initial marker to grasp the sheer urgency and scale, think about the cumulative investment figures, the total U.S. dollar investments pouring into AI infrastructure just across the major players. Well, in only the last 5 months or so, it's nearing a colossal $1 trillion.
Wow, $1 trillion in 5 months.
Yeah. And this isn't, some vague long-term budget plan. This is money committed, contracts signed, resources being deployed right now. It's like a land grab, honestly, on a scale that's just hard to compare to anything recent.
All right, so let's start by unpacking that scale then, focusing first on the capital expenditures, the CAPEX. That's just accelerating like crazy across big tech.
Well,
These numbers are, well, they really are unprecedented.
They are.
When we look at the four biggest hyperscalers, Amazon, Alphabet, Meta, Microsoft, collectively, they're expected to spend approximately $400 billion just this year on infrastructure.
Right. And what's really crucial to understand here is that these projections, they aren't static, not at all. We are seeing repeated upward revisions in their guidance constantly.
They keep raising the bar.
Exactly. We're already looking at forecasts climbing towards yearly $520 billion for next year. And this consistent raising of the spend floor, it's the clearest signal you could ask for that current demand isn't just high, it's consistently outstripping the existing supply. They build it, and boom, almost immediately the capacity is just consumed.
And we have some really staggering individual CAPEX targets that just illustrate this urgency, right? Moving from the collective hundreds of billions down to the tens of billions for each company. For 2025, Amazon, for example, they're earmarking $125 billion.
Huge number.
Alphabet's aiming for a massive range, somewhere between $91 billion and $93 billion. Meta's guiding towards $70 billion to $72 billion. These are colossal figures for individual companies.
And then you've got Microsoft. Microsoft gives us a fantastic illustration of this growth velocity. They already hit $103.1 billion in CAPEX over the trailing 12 months, the TTM, the last 4 fiscal quarters.
Right.
And get this. They're explicitly expecting their CAPEX growth rate in fiscal year 2026 to be even higher than it was in 2025.
Higher. Not slowing down at all.
Nope. That tells you everything. No slowdown in sight, only acceleration.
And Microsoft's case is particularly revealing, isn't it? Because that aggressive acceleration, it's not just speculative building. It's directly tied to a massive, locked-in, $315 billion commercial commitment backlog.
Exactly, $315 billion. That means customers have already signed on the dotted line. They've agreed to pay for cloud services.
So Microsoft has to spend the money.
They have to spend just to fulfill those promises. The spending is driven by overwhelming, contractually obligated customer demand. That is, right now, outpacing their ability to supply the compute.
They aren't building a field of dreams hoping people will come.
No. They are literally building data centers as fast as they can to host clients who are already lined up, waiting. Sources are suggesting Microsoft needs to basically double its physical data center footprint in the next 2 years, just to meet these existing commitments.
Wow. Okay, so this brings us to a pretty fundamental financial question then. How are these companies, even these cash flow behemoths, how are they funding this kind of rapid escalating expansion? Even with their legendary cash generation, CAPEX is rising so fast. Is internal cash flow always enough?
That's a great question, and often The answer is no, not quite enough to keep pace. This is why we need to look closely at the financing mechanisms they're using.
Yeah.
And this is where the story gets, well, really interesting. You just don't undertake major corporate bond deals unless you need immense amounts of liquidity, like right now, for a very defined strategic purpose.
And we saw some big ones recently.
We did. We saw Meta issue a massive $30 billion bond deal, and Alphabet priced a $25 billion bond deal.
And what's fascinating there, I think, is that both of those deals, they were explicitly marketed to fund this AI infrastructure build-out, weren't they? It wasn't just general corporate purposes.
Exactly. It was earmarked for AI, yes.
Yeah.
And this deployment of major debt, even by companies swimming in cash, it tells us two really important things. One, they probably want to lock in the current, relatively lower interest rates for these long-term assets they're building. Makes sense.
Okay.
And two, the urgency is just paramount.
Yeah.
They cannot wait for quarterly cash flow to slowly accumulate. They need that capital now. They need it to secure the hardware, secure the real estate for data centers before their competitors snap it up. Right now, the speed of deployment is actually more valuable than the marginal cost of that capital.
Get the capacity first, worry about the financing nuances later.
Pretty much. It's a land grab.
Okay. Now, let's drill down a bit. Let's get to the foundational level of this arms race. The hardware itself, because there is one company that has become, well, you could almost call it the single point of failure, and definitely the undeniable hardware driver of this whole boom, Nvidia.
Oh, absolutely, Nvidia. They are unquestionably the poster child for this entire moment. I mean, we saw their share price climb, what was it? An astonishing 4,300% in the 5 years leading up to 2024.
4,000%. It's staggering.
It really is. And that trajectory, naturally, it stirred immediate comparisons to Cisco's peak right before the dot-com bubble burst back in 2000.
Right. Cisco was selling the plumbing back then, the routers, the switches, the fundamental networking gear that powered the internet. Nvidia is selling the specialized brains, the GPUs, for the AI revolution.
Precisely. And you see that dominance reflected starkly in their balance sheet. Crucially, the Nvidia data center segment, that's part selling these specialized GPUs, it now generates over 91% of the company's total revenue.
91%. So they're not really a diversified tech company anymore.
Not really, no. I mean, they might have other lines of business, but fundamentally, they're a company that sells the compute power necessary for modern AI development.
Yeah.
That's the engine.
But the question still remains. What fundamentally changed, say, in the last year or so, that pushed demand for these GPUs from just being high to truly, exponential extremes? It feels like it's not just about running basic chatbots anymore.
That is the pivotal technical driver. That's what justifies, or at least attempts to justify, that $1 trillion investment figure we mentioned. We are moving beyond simple generative AI, the stuff that just spits out text or an image based on a simple prompt.
Right, like ChatGPT writing a poem.
Exactly. We're moving from that to what the industry is calling reasoning and agentic AI.
Okay, unpack that for us. What does agentic really mean in practical terms? How does that differ?
Think of it like this. Simple generative AI can, write a basic poem or maybe summarize a document you give it. It's sort of instantaneous, often a single-step output. Agentic AI, however, that's a model that can perform complex multi-step tasks and involves planning. So, for example, it doesn't just write a poem about London. It might be able to research the feasibility of opening a new restaurant in London, generate a budget for it, maybe plan a basic marketing campaign, and potentially even execute actions like drafting emails to suppliers or scheduling social media posts. It involves, longer-term planning, memory, self-correction along the way.
So it's not just generating content, it's actually doing things, execution.
Precisely. Generation plus execution. And the research coming out indicates that this shift, moving from just simple generation to complex planning, reasoning, and execution, it requires something like 100 times to even 1,000 times more compute power for these really complex tasks.
1,000 times. Wow.
Yeah, a colossal step up in demand for deep reason capabilities. That is the underlying technical force driving this CAPEX explosion we're seeing right now.
Which brings us back to Nvidia, this overwhelming reliance on a single supplier. That must be creating a massive systemic risk for the hyperscalers themselves, right? I mean, if Nvidia stumbles or can't produce enough chips.
Oh, absolutely. If Nvidia sneezes, the entire AI economy catches a cold. It's a huge dependency. And it's precisely why companies like Amazon, Alphabet, Microsoft, to some extent, are pursuing this custom silicon strategy. It's a necessary, almost defensive countermeasure.
building their own chips.
Exactly. You see this defensive move everywhere, and it's a massive sunk cost they feel they have to undertake.
Yeah.
Alphabet, for instance, they pioneered their TPUs, the tensor processing units, years ago, designed specifically for their neural network training and inference needs.
Right.
Amazon has developed its own pretty robust suite now with Trainium chips for the really high-end model training and Inferentia chips specifically optimized for serving those models efficiently to customers. That's the inference part.
And the rationale behind spending billions on developing these custom chips. It's powerful, isn't it? It seems to operate on two critical levels. First, controlling that custom silicon lets them optimize the entire hardware and software stack together.
That's key. They can tailor the chip precisely to how their own AI models work, achieving efficiencies, maybe speeds, that are simply not possible when you're running on more general-purpose third-party chips like Nvidia's. You get better performance for your specific workloads.
And second, and this is probably more important for the bottom line, right? They can often undercut NVIDIA's pricing, especially for those high-volume inference workloads.
Exactly. Inference is the big one long term. That's where you're constantly processing requests using the already trained models for millions, maybe billions of users. If they can achieve better unit economics, cheaper cost per query on inference using their own chips, it drastically improves their margins. And, crucially, it reduces their dependency cost on NVIDIA. That's a massive strategic advantage in this game.
Okay, so we've got the massive scale, the funding mechanisms, the hardware shift towards agentic AI requiring more compute, and the custom silicon response. Now let's look at how the biggest players are actually positioning themselves strategically. We need to analyze this high-stakes clash, particularly between, say, Amazon and Alphabet, who seem to be pursuing two fundamentally different full-stack strategies.
Yeah, we call this the battle of the stacks because, as you said, these are vertically integrated companies. They really want to own or at least control all four key layers. The semiconductors at the bottom, then the AI platform layer, the cloud infrastructure itself, and finally the end applications that users interact with.
Right. Let's start with Alphabet's strategy. You described it as vertical integration, almost like a walled garden. What really defines that approach?
Alphabet, or Google, they prioritize, I'd say, ruthless optimization of that entire stack, right from their custom TPU chip all the way up to the end user application. Their strategy is fundamentally about integrating their own proprietary models like Gemini deeply, tightly, into their core established applications that billions already use. Search, Workspace, Android, maybe even specialized units like Waymo for self-driving.
So the goal is really monetization by enhancing and kind of locking people into their existing products. Make search better with AI, make docs better with AI.
Exactly. They prioritize internal efficiency and creating this very cohesive, optimized ecosystem where every part of the Google machine is talking to the other parts seamlessly. The idea is you don't really need to leave the Google environment to get things done with AI.
Okay, the benefit there is probably superior performance and maybe better cost efficiency because they control the whole pipeline?
Potentially, yes. That's the goal. But the trade-off is it imposes a certain rigidity, right?
Yep.
It's basically you use our chip, you use our model, you use our software. It's less flexible for developers or customers who might want to mix and match.
Okay, so let's contrast that sharply with Amazon's strategy. You called it the open platform or the marketplace approach, and it's anchored by their service AWS Bedrock. This sounds designed to be pretty much the exact opposite of a walled garden.
It really is. You could call it the ultimate hedging strategy in this space. Amazon, through AWS, prioritizes flexibility, optionality, and resilience above all else. AWS Bedrock is essentially, not an AI supermarket or maybe a clearinghouse is a good analogy. It allows customers to access a whole variety of different foundational models.
From different companies.
Right, from Anthropic, from Meta with their open source Llama models, from Stability AI for images, from Cohere and others, plus Amazon's own models, of course. And they can access all of these through one unified, simplified API.
I really like that marketplace analogy because the genius of that strategy, it seems, is that Amazon wins regardless of which specific AI model actually prevails in the market, doesn't it?
Precisely. That's the core idea. If, say, Anthropic's Claude model really dominates the enterprise market for complex tasks, which it seems to be doing right now, Amazon benefits immensely. Why? Well, first, they have a huge strategic investment in Anthropic. Second, AWS is hosting the vast majority of that Anthropic usage via Bedrock.
Right.
But even if Amazon's own foundational models, like their Titan or newer Nova models, don't quite hit the #1 spot, their overall AI strategy doesn't collapse because AWS is still the platform hosting all the winners, whoever they turn out to be. This platform optionality fundamentally diversifies Amazon's risk. It reduces their long-term exposure to the, frankly, unpredictable swings in model quality and popularity.
Okay, so while these hyperscalers like Amazon and Alphabet are racing to build out capacity and playing these strategic games, the actual model developers themselves, the ones creating the AI like OpenAI, they seem to be showing immense financial vulnerability. Are they potentially the weak link in this whole value chain? They seem to be the definition of high ambition, but also incredibly high cash burn.
The cash burn is, uh, well, staggering is the only word for it. You look at the public statements from CEO Sam Altman. He's spoken about the need to invest something like $1.4 trillion in infrastructure spending over the next 8 years. $1.4 trillion.
That number is just mind-boggling.
It is. And when you compare that $1.4 trillion long-term ambition from OpenAI to the, say, $400 billion the big four hyperscalers are spending collectively in just 1 year, it really highlights the almost impossible scale of OpenAI's infrastructure needs relative to their current size and resources.
Yeah, that really puts their financing challenge into stark perspective. And we have to contrast that ambition with their current financials. Altman has suggested their revenue run rate is now above $20 billion annualized, which sounds impressive.
It does in isolation.
But then you see reports indicating that OpenAI incurred a whopping $12 billion loss in the last quarter alone.
Exactly. 12 billion burned in 3 months.
Yeah.
That kind of sustained deficit, it's just mathematically unsustainable without absolutely massive continuous capital injections.
Yeah.
And that fundamental necessity is what drove their recent very high stakes financial maneuvering.
You're talking about the corporate restructure.
Yes. The research points out that the corporate restructure refashioning the company into this OpenAI Group Public Benefit Corporation, or PBC, with this unusual nonprofit board control structure, it was at least partly designed specifically to secure financing and provide the flexibility they needed for these large-scale, potentially unconventional funding rounds.
Right, because traditional VC funding probably can't cover these kinds of numbers anymore.
Not even close. And crucially, this restructure was directly linked to their future funding path. Altman himself stated publicly that an initial public offering, IPO, was probably the most likely path forward for the company. Why? Simply because no private deal is likely big enough to raise the colossal kind of capital they require for this $1.4 trillion infrastructure commitment. They need public market scale.
And that restructure, it had immediate, tangible consequences on their relationships with their cloud providers, didn't it?
It absolutely did. One of the key outcomes was that it removed the exclusivity constraint they previously seemed to have with Microsoft, their primary backer. And that immediately allowed them to go out and secure that massive $38 billion strategic partnership with Amazon Web Services, AWS.
So this AWS partnership wasn't just a nice-to-have diversification move. It sounds like it was potentially a necessity for survival, or at least continued scaling.
I think that's fair to say, absolutely. That deal specifically gives OpenAI access to immense compute resources on AWS, including, critically, hundreds of thousands of state-of-the-art Nvidia GPUs. These are currently the rarest, most valuable commodity in the tech world.
Right.
So by entering into the AWS partnership, they're literally diversifying their cloud dependency. They're diversifying their supply chain for compute because the sheer scale of their infrastructure needs is simply too great for any single partner, even a giant like Microsoft, to handle alone reliably. They need multiple providers.
And the clock is ticking for them, isn't it? Because competitive erosion in the large language model space seems immediate and quite severe. OpenAI had this huge, commanding early lead in the enterprise market, but that seems to have evaporated very quickly.
Yeah, they've fallen hard and fast in that specific enterprise segment. Recent data suggests they now capture only about 25% of enterprise usage for these models.
Down from what must have been near dominance a year ago.
Pretty much. And look at their immediate rival, Anthropic. Anthropic has apparently seized the enterprise B2B lead, capturing 32% market share. And reports suggest this shift is being driven by developers preferring Anthropic's models, like Claude 3, for the really high-value, complex tasks like coding assistance and deep reasoning.
So the market is learning very quickly that just being first doesn't guarantee sustained dominance, especially when the capital requirements are this extreme and the competition backed by other hyperscalers is this intense.
Exactly. It's a brutal, fast-moving market.
Okay, so this combination, the extreme financial commitments, the breakneck acceleration of CAPEX, the intense competitive jockeying, OpenAI's precarious finances, it inevitably brings us to the ultimate, maybe perennial question. Are we actually in an AI bubble? Or is this truly the foundation of a new industrial revolution? Let's start by laying out the key arguments suggesting the market is overextended, maybe strongly reminiscent of the dot-com era.
Yet the parallels are, well, frankly, they're hard to ignore sometimes. And they often begin with extreme market concentration. The research confirms what many people feel instinctively. The Magnificent Seven stocks, Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla, they now comprise over 30% of the S&P 500's total market value.
30% from just 7 companies. That's already a pretty significant warning sign in historical market terms, isn't it?
It is. But if we narrow that focus even further, just down to the 4 key AI hyperscalers we've been discussing, Amazon, Alphabet, Meta, and Microsoft, some analyses suggest they alone account for approximately 37% of the entire market's weighting.
Wow, even more concentrated than the Mag 7 figure.
Yeah. And that level of concentration, historically, it often precedes major market shifts, or at least significant periods of volatility. When such a disproportionate amount of the market's value is tied to the performance of just a handful of companies, well, any minor disruption in their outlook or performance can have major systemic consequences for the entire index for everyone's 401k.
Okay, so beyond just the market cap concentration, critics are pointing strongly to the systemic interconnectedness risk. They're drawing this uncomfortable parallel back to the 2008 financial crisis, where key institutions were deemed too interconnected to fail. Is there a similar risk here?
That's a deep and I think fundamental concern being raised. It's not just about one single large company potentially failing. It's more about the opaque, complex web of financial transactions and dependencies that could potentially unravel the whole ecosystem if one key player stumbles.
Like OpenAI.
OpenAI is often cited as the prime example here, given its massive cash burn. They have billions of dollars tied up in what some analysts are calling circular investments, with companies all across the AI supply chain. Nvidia, Microsoft, AMD, Oracle, and even that private data center firm, CoreWeave.
Okay, explain circular investments. What does that actually mean? Is it just borrowing from Peter to pay Paul on a massive scale?
That's essentially the criticism, yes. Critics suggest that this complex multi-billion-dollar web of investment, cloud credits, and hardware purchase agreements is effectively artificially propping up the trillion-dollar AI boom. The argument goes, OpenAI gets investment or credits from Microsoft and others, uses that to buy compute capacity and chips from Nvidia and cloud providers, which boosts their revenues and valuations, justifying further investment back into OpenAI or similar ventures. It's a loop.
Right. So if OpenAI were to stumble financially, if their revenue growth slows dramatically, or they fail to secure that next massive tranche of capital they clearly need, the financial reverberations could instantly shake its suppliers and investors across the entire ecosystem.
Exactly. It could create a domino effect where a private company's financial distress directly impacts the results and stock prices of trillion-dollar suppliers like Microsoft and Nvidia. That's the systemic risk concern.
And layered on top of that is the sheer valuation question. To justify the current stock prices, especially for Nvidia, and the monumental CAPEX we discussed, the revenue figures required down the line seem almost impossible to imagine. Projections indicate that the annual AI revenue generated globally would need to hit something like an astonishing $2 trillion by 2030.
Yeah, $2 trillion. That is the staggering level of future growth and monetization that seems to be baked into today's valuations. And furthermore, let's not overlook a crucial technical point often missed in the hype, the obsolescence argument.
How does that fit in?
Unlike past infrastructure booms, think about laying national rail networks or fiber optic cables across continents. Those were assets with useful lives measured in decades, right?
Yeah.
They provided returns for a very long time.
Okay.
The costly high-end AI chips, the Nvidia GPUs, and the custom silicon that are driving this current investment boom, they likely need to be replaced every 2 to 4 years, maybe 5 at the outside, due to relentless rapid technological cycles. Moore's law might be slowing, but AI chip performance is still advancing incredibly fast.
So the very assets driving this huge CAPEX spike are inherently short-lived. They require continuous massive reinvestment just to stay competitive. Does that limit the long-term productivity gains compared to previous infrastructure revolutions?
That's the argument. It potentially creates this kind of CAPEX treadmill effect. The moment a state-of-the-art, very expensive chip is installed in a data center, it is already on the road to obsolescence. It demands the next generation of investment, the next round of spending, simply to maintain competitiveness, let alone gain an edge.
Okay, that makes a very compelling, maybe slightly bearish case for a potential bubble fueled by concentration, circular funding concerns, and this rapid technological turnover. But let's flip the script now. What are the strongest arguments against calling this an AI bubble? What about the strong financial fundamentals of the incumbent players?
Right, and this is the crucial counterargument: financial quality and sustainability. Unlike 1999, this AI wave is primarily being financed by highly profitable incumbent companies. Amazon, Microsoft, Google, Meta. Their core businesses outside of AI generate enormous predictable cash flows. Big tech is largely using their own massive cash piles, their internal cash flow, to fund this CAPEX surge.
And that is the fundamental difference from the dot-com bubble, isn't it? Back then, you had hundreds of often unprofitable startups, heavily reliant on external capital, venture funding, high-yield debt, just burning through cash they didn't generate
Yeah,
themselves.
exactly. Today, it's largely the established titans of industry writing their own checks for this build-out.
Hmm.
We could look at Amazon again as an excellent example.
Right.
Even after committing well over $100 billion now to AI-related CapEx, Amazon is still generating nearly $15 billion in free cash flow on an annualized basis after all that spending.
So they're funding a revolution while still producing massive amounts of excess capital from their other businesses.
That's right. And the macro data seems to back up this stability argument too. If you look across the broader S&P 500 index today, companies are, on average, generating about 3 times the cash flow as a share of their market valuations compared to the period leading up to the dot-com bubble burst in 2000.
So while the high concentration risk is definitely real, the underlying balance sheets and the cash generation capabilities of these key incumbent players seem fundamentally healthier this time around.
That's the argument, yes. The cash flow provides an enormous buffer against volatility or delays in AI monetization. Even if that $2 trillion AI revenue target doesn't materialize exactly by 2030, these companies are highly diversified. They have huge businesses in cloud, retail, advertising, software. They can absorb these massive investment costs far better than the pure play, often single product, tech stocks of the late 90s could.
Okay, let's pivot slightly to a related subject, something that's happening alongside this boom. The human cost, specifically the mass job cuts we've been seeing. Over 60,000 corporate jobs were reportedly cut just this year across major players like Amazon, UPS, Target, and others. This certainly raises valid questions about, an immediate AI-driven recession where automation is suddenly eliminating white-collar work at scale.
Yeah, it's a really sensitive topic, and the official management narrative you usually hear attributes these widespread layoffs to a renewed focus on efficiency. They talk about cutting what they deem corporate bloat that built up during the pandemic hiring surge, or adjusting to slowing sales growth, or maybe broader economic headwinds.
Right, like Amazon CEO Andy Jassy framing the cuts as necessary to operate more like the world's largest startup, meaning nimble, efficient, and laser-focused on allocating capital towards future growth areas like AI.
Exactly, that's the official line.
Okay.
But the research and analysis we looked at suggests we probably need to maintain a healthy degree of skepticism regarding that clean narrative. Several experts are pointing directly to the phenomenon of AI washing.
AI washing. Explain that.
That seems to be the critical distinction analysts are making. Experts suggest that some companies might be increasingly engaging in AI washing. That is, they're blaming job cuts publicly on the adoption of sophisticated new AI technology, partly as a way to cover up maybe more mundane, old-fashioned business fumbles, poor management decisions, or just simple necessary cost-cutting due to missed targets.
So they're potentially using AI as this convenient, futuristic-sounding excuse for what might actually be painful but unrelated corporate restructuring.
That's the contention, yeah. The simple fact, according to these analyses, is that there's actually very little hard evidence that AI has eliminated jobs at the scale being announced right now, today, implementing complex AI solutions effectively into enterprise workflows. It's complicated, it's time-consuming, it's not like flipping a switch and instantly replacing thousands of workers. Okay. So the argument is that many of the job cuts we're seeing are likely still primarily motivated by traditional goals like efficiency improvements, post-pandemic right-sizing, and general cost control, rather than immediate systemic replacement by AI tools just yet. The AI impact might come later, but perhaps not as immediately as the headlines imply. We also can't ignore that this financial arms race, this AI build-out, it's not happening in a vacuum. It's not just confined to Silicon Valley or
Well,
Seattle. It has this massive geopolitical component, primarily pitting the U.S. against China for long-term AI supremacy. And that adds yet another significant layer of risk and complexity for investors and policymakers alike.
yeah, the stakes feel incredibly high on that front. And we have to bring up that incredibly blunt assessment from Nvidia CEO Jensen Huang regarding the outcome of this international competition. He reportedly said, quite starkly, China is going to win the AI race. I mean, that is a massive statement coming from arguably the single most important hardware player in the world right now.
It's a huge statement. And his warning, according to the reports, is rooted in fundamental economics, specifically the cost of energy. Huang pointed directly to China's government energy subsidies, which he argues effectively make power is free or significantly cheaper for local Chinese tech firms running homegrown chips in massive data centers.
And why does that matter so much? Just cheaper electricity.
It's more than just cheap electricity. Data centers consume absolutely colossal amounts of power, not just for running the chips themselves 24/7, but critically for cooling them. Power and cooling are major operational expenses, a huge line item for hyperscalers. So if energy costs are artificially suppressed or heavily subsidized for Chinese competitors, well, it creates a powerful, potentially insurmountable competitive disadvantage for U.S. firms operating purely on market economics. China could simply afford to run more compute for longer periods at much lower operational costs.
Okay, that's a sobering perspective on the cost side. Meanwhile, on the U.S. side, regarding the systemic risk we discussed earlier, there seems to have been a fairly clear signal of financial discipline from policymakers, at least rhetorically. David Sachs, who served as President Trump's AI advisor, or czar for a time, explicitly stated there would be no federal bailout for AI. That seems like a firm rejection of the too-big-to-fail concept applying to, say, OpenAI or its rivals, regardless of their perceived strategic importance.
Right. That stance strongly emphasizes that the private market ultimately bears the risk of these ventures. However, Sam Altman himself, from OpenAI, proposed a potentially more constructive alternative role for the government. He suggested establishing a strategic national reserve of computing power, basically, AI infrastructure that would be owned and managed directly by the government.
Interesting. So rather than directly subsidizing private companies or risking bailouts, the government would ensure national access to cutting-edge compute resources, maybe for academic research, national security applications, things like that.
Exactly. The idea is it would enhance the national strategic position in AI and provide critical resources, particularly for research and defense, without necessarily risking a messy private sector bailout or directly distorting the competitive marketplace through subsidies for specific private data centers. It's an alternative path.
Okay, let's switch gears completely for a moment. Let's try to connect this monumental CAPEX, this $500 billion being spent annually by just a few companies, to tangible consumer applications. Where does this massive investment actually show up? What are the real-world benefits that are either being deployed now or coming very soon for the average person?
Yeah, that's a great question. Where does the rubber meet the road? A lot of this investment is going into making existing applications much smarter, more helpful, more anticipatory. A prime example is creating an all-knowing copilot right within Google Maps. They're deeply integrating their Gemini AI models to create a much more proactive, hands-free, conversational navigation experience. The goal is to make navigation far more intuitive based on real-world context, not just abstract distance measurements.
That sounds incredibly useful, especially for reducing distracted driving, right? Can you give us some examples of the new navigation cues they're deploying?
Sure. They're moving far beyond just saying, turn right in 500 feet, which, let's be honest, is often useless when you're driving in a dense, unfamiliar city. Google Maps is integrating what they call landmark-based directions.
Okay.
The Gemini AI processes literally billions of Street View images and cross-references them with Google's database of 250 million logged places. The result is it can give much clearer, context-rich audible cues like, okay, turn right immediately after the Thai Siam restaurant, or take the third exit, the one past the green brick building on your left. This uses visual cues humans naturally use, drastically improving situational awareness.
And the hardware integration is getting more advanced too, right? It's moving beyond just the phone app and into the vehicle's own systems.
Absolutely. One example highlighted is the new live lane guidance feature. It's debuting in newer car models, like the Polestar 4 electric vehicle. It uses the car's own front-facing camera, combined with AI processing, to provide real-time audio and visual cues about exactly which lane you need to be in for upcoming merges, lane splits, or exits, even factoring in current traffic conditions. This kind of proactive guidance aims to reduce driver stress about missing turns and just ensure a smoother, safer drive.
And it apparently monitors your regular routes in the background too, even if you don't start navigation.
Yes, that's another feature. The AI is designed to learn your routine commutes and monitor traffic conditions along those routes in the background. The goal is to provide proactive traffic alerts for unexpected disruptions, accidents, sudden congestion, even if you haven't actively opened the Maps app yet. The system identifies significant deviations from your usual travel time and can alert you to potential problems before you even get in the car. That kind of proactive efficiency, that adds real value to the consumer experience.
Okay, so that's Google. Meanwhile, Amazon seems to be leveraging its AI muscle, particularly its expertise in logistics and pricing optimization algorithms, to attack the global low-price retail market more aggressively.
That's right. Amazon is significantly expanding its ultra-low price shopping section, reportedly planning a global rollout via a standalone Amazon Bazaar app. This looks like a direct, calculated competitive response to the rapid rise of rivals like Temu and Shein. Amazon aims to use its AI prowess for hyper-efficiency in supply chain management, global logistics, and dynamic pricing to aggressively capture global market share from those emerging, often China-based, low-cost players.
Okay, we've covered a lot of ground. The incredible scale of investment, the shifting hardware drivers, the contrasting hyperscaler strategies, OpenAI's financial tightrope walk, the bubble debate, the systemic and geopolitical risks, and finally, some tangible consumer benefits. It feels like time for the final verdict. Synthesizing all this, what is the prudent strategy for you, our listener, the investor, and the learner trying to navigate this environment of extremes right now?
Yeah, the conclusion really has to be balanced. We have to acknowledge both the immense strength and likely endurance of the Titans, but also the inherent fragility of the overall market structure given the concentration. So while the Mag 7, or maybe just the core AI hyperscalers, will likely remain leaders for the foreseeable future, simply due to their almost insurmountable advantages in cash flow, existing infrastructure, and attracting talent, the historical precedent of such extreme market concentration absolutely dictates caution, betting the entire farm on the continued, perpetual astronomical outperformance of just 4 or maybe 7 stocks. Well, that's historically been fraught with systemic risk.
So the core takeaway seems to be diversification, but maybe diversification with a highly specific, disciplined focus on what you are actually buying into.
Exactly. I think the prudent strategy is probably twofold. First, maintain selective exposure to the proven cash flow leaders. We're talking here about companies like Amazon and Alphabet, perhaps Microsoft, who demonstrably have the massive balance sheet and core profitability to fund this relentless innovation without relying solely on debt or fickle market sentiment. Focus on the financially strongest.
Okay, selective exposure to the leaders. What's the second part?
The second part is aggressive diversification away from that concentration, specifically into undervalued sectors, where the efficiency gains from AI are likely to yield the highest potential returns relative to their current valuations.
Right. Where do we look for that kind of diversification? Where might AI-driven efficiency gains be most transformative relative to current market expectations?
We look where the market isn't already crowded and expensive. We focus on sectors that have perhaps been depressed or overlooked for years, but are fundamentally ripe for automation, optimization, and margin improvement through AI. That could include areas like consumer staples, which have that non-discretionary demand and stable cash flow profile. It could include healthcare, with its demographic tailwinds and potential for AI in drug discovery and diagnostics. And maybe even some of the more cyclical sectors like commodities, industrials, and transportation, which stand to benefit dramatically from AI-driven gains in supply chain optimization, autonomous logistics, predictive maintenance, and resource management.
That makes sense. It really brings us back to that foundational lesson that seems to surface during every major technological boom, doesn't it?
Indeed, it bears repeating. The core investment philosophy lesson we learned, often the hard way, from the dot-com era, remains profoundly true today. Great technologies and great investments are not always the same thing. Just because the technology is world-changing doesn't mean every company associated with it is a guaranteed win at any price.
Prudence is absolutely key, especially in a world casually throwing around trillions of dollars in investment figures. Your objective for you listening and navigating this hyper-concentrated, high-spending environment is ultimately to ensure that when the music inevitably slows down or the market takes a severe correction, you still own businesses that fundamentally make money, not just stories that desperately need it.
Define the risk, then look at the reward. That's the process.
Well said. Thanks for diving deep with us today on this AI arms race. We'll see you next time on Griffonomics.